All right, welcome to Talk Tickers. Today, we're diving into Workhorse Group's latest earnings call. And wow, what a call it was. You've got record revenue, a huge merger announcement, and the stock just tanks. It makes no sense on the surface, right? So let's try to figure out what on earth is going on here.
Yeah, this is really the heart of the matter. I mean, you look at the headlines and everything seems great. A record quarter, a big strategic move. So why the nearly 10% drop? Well, as soon as you look past those headlines, you start to see the cracks. And that's exactly what we're going to unpack here. Okay, so let's get into it. Section 1, the paradoxical quarter. We're going to start with the big numbers because honestly, they tell a tale of two completely different companies. One side looks amazing, like it's firing on all cylinders. The other side, well, it shows a really deep fundamental problem that investors just couldn't look past.
So let's start with the good stuff because there was plenty of it. Revenue came in at almost $5.7 million. Now, get this. That's a 573% increase from last year. 573%. Not only is that a record quarter for Workhorse, but it absolutely crushed what analysts were expecting. They were looking for something closer to 2.3 million. So a huge beat on the top line.
And you know what? The story gets even better when you look at the bottom line. Now, they did lose money, $1.67 per share, but, and this is a big but, Wall Street was expecting a loss of nearly $4 a share. So this was another huge beat. It kind of suggests they're getting a handle on their costs. So far, everything's looking great, right? Well, here's where the wheels fall off. This is the number that completely changed the narrative. A gross margin of negative 130%. Let that sink in. For every single dollar they made from selling a truck, they actually lost $1.30 just on the cost of building it. That's before paying for things like research or sales or keeping the lights on. That kind of math is just, it's completely unsustainable. That's the red flag investors saw. Okay, section 2, the merger solution. So you've got this crazy situation, record sales, but you're losing a ton of money on every single vehicle. What do? Well, Workhorse's answer is a big one. They're merging with another EV company, Motiv, in a massive all-stock deal.
So here's the deal at a glance. It's an all-stock transaction, which means no cash is changing hands. The new combined company is going to be valued at about $105 million. And interestingly, it's Motiv CEO Scott Griffith who will be leading the new charge. They're aiming to get this all wrapped up by the fourth quarter of this year. So why are they doing this? Well, the logic is pretty straightforward, and honestly, it's a move they probably had to make. In the EV game, scale is everything. It's survival. By teaming up, they're hoping to buy parts cheaper, what we call lowering the bill of materials. Plus, it can offer customers a complete lineup of trucks, from Class 4 all the way to Class 6. But maybe the biggest thing, it makes them look a lot more stable to those huge fleet customers. Those are the buyers who might have been hesitant before, wondering if Workhorse would even be around in a few years. And you really have to see this in the context of the wider EV market. This move isn't just about getting bigger for the sake of it. It is absolutely about survival. We've all seen what happened to companies like Fisker and Lordstown, right? They went bankrupt because they just couldn't get big enough fast enough. So you can think of this merger as Workhorse and Motiv banding together to try and avoid ending up in that same EV graveyard. All right, section 3, dilution, doubt, and downside. This brings us back to our big question. If this merger is so important for survival, why on earth did the stock just plummet? Well, it all boils down to some pretty painful math that investors had to do on the spot. And here is the #1 reason for the sell-off. Just look at this ownership structure. After the merger, the existing Workhorse shareholders, they're only going to own about 26.5% of the new company. That is a massive dilution. Essentially, control of the company is being handed over to Motiv's investors.
So you can just imagine investors seeing this news. They're weighing the potential for long-term survival against the reality of their stake in the company getting absolutely crushed right here, right now. And then you throw in those terrible negative 130% margins we talked about, and the fact that the company flat out said they'll need to raise more money down the road. It's just a perfect storm of concerns. No wonder people hit the sell button. And the chatter from the market pretty much confirmed this. You saw notes saying things like the deal has near-term pressure, even if the strategic logic makes sense. And really, that hits the nail on the head. Everybody gets why they're doing this merger. It's a smart long-term play. But the short-term pain, that dilution, that uncertainty, it was just too much for the market to stomach right now. So, where do they go from here? This brings us to section 4, the next call, our thesis. Let's look ahead and try to figure out what the new combined company needs to do to turn this story around. Okay, so looking forward, there are a few huge things we need to watch. The new leadership has a ton to prove. First, they've got to close this merger by the end of the year, no delays. Then they need to launch their new products on schedule. But the big one, the one everyone will be watching, is whether they can actually find those $20 million in cost savings they're promising. And at the end of the day, the real test will be seeing big fleets coming back and placing more orders. That's the ultimate vote of confidence. So with all that in mind, our rating on the stock is market perform. It really feels like a high wire act right now. On one hand, if they pull this off, if they actually execute on this plan, they could become a real force in the commercial EV world. But on the other hand, the risks are just massive. You've got the dilution, the cash burn, the challenge of putting two whole companies together. It's just a perfectly balanced risk versus reward situation, which is why we're staying on the sidelines with a market perform. But let's talk about a potential high-risk trade idea here for the next call. Our thesis is pretty simple. The market has basically written this company off. The expectations are so low right now, it's incredible. So if the new team can just clear a couple of low hurdles, like successfully close the merger and then show even the slightest bit of progress on those cost savings early next year, this stock could pop. The speculative move would be to wait for the merger to officially close and then consider a position, betting that any good news will bring investors back. And of course, we have to close with this very important reminder. Everything we've discussed here is for informational purposes. This is an explainer, not a recommendation. This is not financial advice.